Hello, I'm Harry Watton. Welcome to this week's Market Matters weekly video update for Wednesday, the 22nd of June. James, it's been a big week on the desk. How are you going personally, and how are you going with the Market Matters website at the moment?
Thanks for your concern, Harry. You've obviously been listening to Gus Worland's podcast lately, so no, it has been a busy week. Where, as I was just telling you off air, we're very close to launching the version 3 of the Market Matters website. So really excited about that. We've been all focused on that this week, obviously, plus reports and all the other things that we take into consideration on a weekly basis. But this is going to be a big development for It's going to bring in some really interesting charting features. So you'll be able to chart all of your favourite stocks. You'll be able to look at fundamental data, broker consensus and the like. And I think there's some really cool features that we're putting in there. So I think it'll be a big step up in terms of the web presence for Market Matters. Be great for our existing subscribers, and hopefully we'll attract a few new ones, Harry. So a big week, but a really exciting one.
Massive week, really changed the data offering we give to subscribers. It's been a big week on markets as well, James. Really volatile, month of June so far. 3 weeks into it now. Sitting on sort of a top level, big picture stuff. Where do you see markets here heading into the end of financial year?
Yeah, it's been pretty, I say choppy, but it's been pretty much all one-way direction. So it's been on the downside. The ASX is down 16% from high to recent low. The US market's off worse. It's down about 25%. We've written a couple of times in reports, if you stand back and look at what the typical correction from a recession is, it's about 30%. So we're pretty much, where if you look at the US market, we're a long way into that correction. Some have gone more. So there's been, GFC went 50 and a couple of others have gone bigger. So it can still go more. But if you think about when should I be allocating money to the market, or how should I be positioning? Should I be selling at this juncture? I would focus on that sort of statistic. From my point of view, advising clients on positioning around the market, I'd never strongly suggest people sell after the market has fallen so far. I think history will show that holding nerve in this during periods like this is key, and I think that's what we've been trying to present through our Market Matters reports in the last couple of months, Harrison.
The biggest sector in the Australian market still sort of the banks. Well, the big four banks make up a big portion of the ASX 200. So that's where we're going to start looking at sort of sector point of view. What are your take on the banks here?
Yeah, I mean, they've all been knocked pretty hard over the last little while. So that's obviously there's sort of a two-edged sword here. So increasing interest rates were meant to be positive for margins, and they have been. But then you've got the offset of that as rising bad debt or stress in terms of bad debt provisioning for banks. We actually caught up with George Frazis yesterday, who's the MD of Bank of Queensland, and just talked about how they're seeing markets overall. So funding markets, they're seeing some upward pressure on funding, and we've seen that. The Westpac launched a hybrid security this week, and there's no sort of clearer way for an investor, normal investor, to see what they're having to pay for funding. So they launched that at 3.4% over the bank bill rate. On that term of hybrid, so 6 years, the bank bill is like 4.5%. So the funding is pretty expensive. Going back to what Bank of Queensland said, and we were pushing them on asset quality, etc. Their asset quality is absolutely fine. George was suggesting that their customers on average are 15 months ahead on their interest rate payments. They've got less than 1% of their loan book on an LVR greater than 90%. Obviously property prices have been really strong. We're all concerned about property prices coming back. But if you think about where they've come from, it can withstand a meaningful decline before borrowers get into trouble, as long as employment stays strong, and we suspect that will be the case. So I don't have an issue or a concern about banks from a bigger picture standpoint. So I don't think that's what we're looking at the moment. I think there's been an adjustment in the market, and I think probably there's now too much of a recession being priced in. So interest rates have gone too high. They won't prove to go that high. The RBA won't have to be as aggressive, and that won't have as bigger impact on asset quality and the like for banks.
The other end of the spectrum in terms of the ASX is resources. We are a little bit underweight resources at the moment overall. I know we've got a pretty decent position in BHP, but looking forward, are we going to be adding to that and maybe switching into an overweight position given they've pulled back pretty heavily in the last couple of weeks?
Yeah, they have, and it's like some areas particularly so. I mean, look at the coal stocks with a Queensland focus yesterday after a change in taxation regime or royalty regime up there. They got hit really hard. It's one thing saying commodities and putting them all in one basket, but there's a lot of ebbs and flows in the different commodities underpinning the space. So, copper, we wrote, it's come back to $4 a pound. We like it there. So we're looking for a way to enter back into the copper space. We've got BHP, which has got copper exposure, but it's also got iron ore exposure. We're less keen on iron ore at the moment, just from a shorter term seasonal perspective. We think energy probably, so oil, probably trades lower in the short term. That's just a short-term tactical view. I know I did a webinar last week and talked about how this lack of investment in old school energy is going to drive higher prices over time. I think that's going to be the case, but in the short term it got pretty inflated. So we took our money out of Woodside, we added a little bit into BHP, and we added to our Aristocrat position. So overall in the resources space, I'm bullish longer term. As Rocky said last week, a period of higher highs, higher lows, etc. The trend is up, but it's going to be volatile, as we've seen this week in the lithium space. I mean, that's been an absolute, some of these smaller lithium companies have been hammered this week. So we're looking at those areas for value as well. So active in the resources space is what I'd be phrasing it at the moment, Harrison.
Definitely. Looking to overseas markets, one we touched on this morning, Lululemon. I own some Lululemon shorts, James.
Of course you do.
Your wife.
Of course
they
you
are probably
do.
the comfiest shorts I do own. We talk a lot about consumer discretionary lately, how that is sort of impacted by higher rates, but we still talk to Lululemon as a company we potentially like and would add to the portfolio. What's your sort of theory there that you're sort of playing both sides of the ledger, James?
Well, you think about investing is all about trying to understand what's captured in the price. So, Lululemon has fallen from just under 500 a share down to the mid 200s, or mid to high 200s. So, it's down 40% from its highs. That's a big decline. What's baked into the cake now? Obviously, the concern is that interest rates go up, consumers tighten their hip pocket. They don't buy on discretionary items like activewear. But I would caution the fact that some items are less discretionary than the others. Whether or not activewear falls into that is another discussion altogether. But you think about now what's on 27 times growing at 20%. That's come back into it's a proper global business with a great brand and a big footprint. I'm buying that on a little bit over 27 times. I think that's not a bad entry point into a really strong global brand. Nike's the same. I mentioned Yeti as a smaller cap overseas. So I think the market's moved a long way against this theme. I think it's probably moved too far against this theme. We'll be cautious when we go in there, but I think those are the sorts of businesses we need to be looking at.
We've seen elastic band stretch further than we thought over the last few weeks in particular. We're going to let you sort of have the floor here, James, and pick out any other opportunities that you might be looking at in the next couple of weeks as well.
Yeah, I saw wrote yesterday afternoon just Aristocrat, and I just cited it then. So that's that looks really good from a short term point of view. We've had a couple of cracks at it. We bought it and it went lower. We've added to it and it's gone higher. I think in the short term it's got a real chance of moving 10 to 20% in a short amount of time. I think we're going to get the volatility in the commodity space is really ratcheting up. So you mentioned this morning Pilbara Minerals for your emerging companies portfolio. I think that looks really encouraging here. IVE Group, so IGL is the ticker for that. They reported this morning. It's integrated marketing business. We recently sold it out of both portfolios that it was in at higher levels. It subsequently got hit pretty hard after that. It's now, they had a trading update and issued forward guidance. They're actually doing a really good job. So that's this is a company very much exposed to what's happening in underlying economies and marketing spend and the like. So that looked really good today. So it's cheap and got a good yield. I like that stock. We took profits in it, and do we regret selling it? Probably not, but it's one to keep on the radar. So there are a few ideas for our viewers out there this week, Harry.
We took profits on Pilbara not long ago as well, and that's below where we sold that. So another chance to buy in below where we let go.
I think that's a good point. So right this morning, looking back, hindsight's a wonderful thing, right? So obviously you've got to be thinking about how you're approaching the market and analysing what you've done in the past and how you can be better in the future. And I think one of those things, this is a market that's going to be choppy. We've seen it in the last 12 months. We're going to see it in the coming 12 months, I think. So we've got to be a little bit more active in our exposures than we have been, and we realise that. To your point around Pilbara and IGL, I think that is two examples where we have been, and it's worked for us. So expect a little bit more activity in this choppy market, which it lends itself to more activity.
All right. Well, I hope subscribers enjoy the new site, and we'll be pretty active. So plenty of work to be put into that as well.